Good morning, everybody, and welcome to this first webinar series for 2026 from IMAP. You join us, of course, on after a weekend in which there's been a fairly major geopolitical event in the Middle East. So it's completely appropriate that we, over the next today and over the next 2 days, we'll be joined by leading portfolio managers who'll talk about global equities in a broad sense, but also specifically how an event like the events in Iran over the weekend are absorbed into and impact their thinking about portfolios. I'm going to be joined today by Michael Karagianis from JANA Investment Advisors, and Andrew Gowen, a portfolio manager from Bell Asset Management. And before I invite them to speak to us today, let me just mention a few IMAP events which we'll be hosting through the rest of this calendar year. In the next 2 weeks, the IMAP Portfolio Management Conference will be hosted in Sydney and Melbourne. And we will have, as the first session for each of those conferences, a geopolitical overview from Wellington Management and JP Morgan Asset Management. So completely appropriate that we bring two large American investment managers to the stage to talk about how they see geopolitical events affecting the way in which investment portfolios are managed. In July, Advice in Action will focus on the high net worth client. How do advisors best serve that client? How do they best find that type of client? And what are the services which appeal to that market segment? In September, Sydney Alternatives Week, this will be the second opportunity for us to host a session on discretionary portfolio management and the use of alternatives. We follow the family office session at Sydney Alternatives Week each year, and I'm looking forward to that. Independent Thought will host a number of the asset consultants and portfolio managers in October. And then in November, our last major event will be an MDA symposium. The MDA instrument, for those of you who work in this part of the market, is an instrument that is renewed every 10 years, and 2026 is the year. So we'll be hosting a session in November after ASIC releases the MDA instrument in October. We've been quite heavily involved with ASIC in the way in which they are approaching the MDA instrument. And between now and October, when they release the instrument, and November, when we host the symposium, we'll be holding a number of MDA-related events. Tomorrow, in this series, Russell Investments and Global X will bring their view of the way global equity markets are evolving. And then on Wednesday, Mercer's and Nanook Asset Management will bring the third set of perspectives. I'm sure you all know how to ask a question, and we welcome those at a time like this. So now it's my pleasure to hand over to Andrew Gowen. Andrew is a portfolio manager with Bell Asset Management and has been 25 years working in global equities across the UK and US. So he brings a depth of experience in global markets to Bell's, more than 15 years as portfolio manager. So Andrew, over to you. Thanks very much.
Great. Thank you very much for having us, Toby. I know I've got a short period of time here, so I'm going to run through things quite quickly. And there's just two topics that I really want to touch on. And one of them is concentration, particularly in global benchmarks. And the second thing is the AI opportunities and risks present at the moment. And at the risk of jumping to the conclusion first, when we think about concentration, the answer for us is diversification, and that's what we've done in the portfolios. And when it comes to AI risks and opportunities, I think a lot of work needs to be done on both sides of that ledger, and having a clear framework and some balance is particularly important. So let me walk through those very quickly for you. In terms of concentration, I think we're all well aware that global equity benchmarks, particularly large cap ones, are particularly concentrated at the moment. 74% of the large cap index is comprised geographically of the US. And within the large cap global benchmark, 46% is across just 2 sectors. And the top 10 stocks within that are more than 30% of that benchmark. And the ASX index is even worse. Obviously, the top 10 names are almost 50% of that index. So I think purely from a risk management standpoint, diversification is particularly important. And when we think about diversification in our client portfolios, we think about it from 2 lenses, both geographic and market cap. And so if you look at the next slide, when we talk about sensible risk management from diversification, it's also been helpful in terms of performance. So if you look at the slide on the top right, when we think about geographic diversification, the large cap benchmark index is in the middle in dark green, and the US is those two bars on the left. That's the NASDAQ and the S&P significantly underperforming the benchmark index year to date. And the bars on the right are Europe and Japan significantly outperforming the benchmark index. So there's a risk benefit, but also a performance benefit, particularly year to date. And when it comes to thinking about things from a market cap standpoint, the charts on the bottom, again, on the bottom left, show the SMID cap global index outperforming the all cap index. That's the dark green bars, outperforming the light green bars. And that's over, again, year to date or 6-month basis. There's been a particularly strong performance on a global stage, but also those bars on the right, again, in the US, the same phenomena persists. And again, what we see is the dark green bars are the equally weighted, either NASDAQ and S&P index significantly outperforming, again, the actual index benchmark in the US. So again, small caps outperforming large caps. And if you look at the next slide, what we really want to highlight here is just that this outperformance of small caps is persistent. It's not a short-term phenomena. So again, the dark green line you see there is the global SMID cap index over the last 25 years, and it's materially outperformed the large cap index over 25 years. And to put some numbers on that simplistically, if you put $100,000 of your client's money into that at 25 years ago, at the turn of the century, you'd now have $700,000 of client money in the SMID cap index and $550,000 in the large cap index. So those decisions make a very big difference over time. And on the next slide, what I really just want to pull out here and mention is that diversification, which is driving both better risk management as well as outperformance, is actually very cheap at the moment. So the chart on the bottom right just shows you the relative valuation of the SMID cap index against the large cap index. And historically, it's traded at about a 5% premium. Now it's trading at a 19% discount. So you get the diversification and the additional growth at a discounted valuation. And I could say the same about the geographic diversification, because obviously Europe and Japan still trading at a discount to the US. So diversification is good risk management. It's driving outperformance and trading at a discounted valuation. In terms of AI risks and opportunities, if we can move on to that topic next, I think I want to sort of encapsulate the question or the concern people have first in this slide, which is basically the very big numbers involved, and the very big and falling numbers scare the heck out of people. And so what you see on the chart on the bottom left is in black, the CapEx numbers for the hyperscalers. I'm sure we've all seen that number, over 650 billion of CapEx to be spent this year, and up to close to $4 trillion by the year 2030. And that's obviously had a commensurate impact on the free cash flow of those hyperscalers, which is what you see in the green lines on that same chart. It's falling. And if you combine those two, you end up with the ROIC, which is the chart on the right, again, going from very high levels in the 30s down to mid-single digits on the right. that's given everyone a cause for pause. And here's where I haven't included math on the chart. So if you're following this, you might want to pick up a pen and paper, but we've got a framework of thinking about the risk and opportunity here, right? A lot of people are concerned about whether you can generate those returns in future years. Here's where I can walk through some simple math with you. If you think about 3.5 trillion of capex to be spent over the next few years, and you'd want to get a 20% return on invested capital on that, as we would, that would equate to about 700 billion of operating profits that you'd need to generate over that period of time. Now, we know software tends to generate a very high margin, 80s or 90s, hardware closer to the 50s or so. Between the two, AI will probably generate about a 70% gross margin on those incremental dollars. So if you divide that 700 billion of EBIT that I need to get on my investment, divide it by 70%, you'll get to about $1 trillion of incremental revenues that spend will have to generate over the next few years. If I divide that by about 1.4 billion white-collar workers in the world globally, that gets me to $700 a year each white-collar worker needs to spend to get me to that 20% return hurdle. We at Bell, we're already spending that number per month. So $700 a year is just $60 a month. We're already spending that. And of course, what I would say is that takes no account of obviously blue-collar workers, students, or just people using it at a personal level. It also, most importantly, takes no account of APIs. So that would be autonomous, pulling off these large language models, or robotics. So in our view, just doing some very simple math without going into too much of our calculations, we can see a very clear case for why these large numbers will actually generate significant returns in future and may in fact be exceeded. So rather than getting terrified by the numbers, I encourage everyone to do the math, and I'm happy to go through that in detail with anyone later on. So stepping on to the next, I guess, concern people have is, will AI eat software? That's clearly the latest iteration of the concerns. And what you've got on the chart on the top left is how things sat maybe 6 or 9 months ago in the market's view. The dark green part at the bottom is Microsoft. The light green part in the middle was the general software complex. And the little black sliver on the top was AI, particularly epitomized by OpenAI, Anthropic. The view of the market 6 months ago was that software would grow its addressable market, would grow its profits. Very quickly over the last 6 or 8 weeks, the market's taken the view on the right that there would be significant crowding out and cannibalization of that black line, shrinking that software opportunity. Our view, again, having looked through a number of product cycles and a number of innovation cycles over time, is that invariably technology, while deflationary, tends to grow the market. Which is not to say there won't be some cannibalization. We just don't believe that the truth is exactly the bar on the chart on the right. And in fact, what I produced at the bottom is OpenAI's own revenue forecast out to 2030. And what you can see there is the largest growing part of their revenue ambitions, that's the pink part on the bottom, is actually consumer. The enterprise part of their business, that's in purple, is actually not the biggest growth vehicle for their revenue forecast. So again, I encourage everyone to do their own work, thinking about what's actually going to play out over time, rather than just looking at big numbers and big headlines. And when people look at big numbers and big headlines, what you tend to get is indiscriminate moves. And we've seen a very good example of this recently, if you flip over the next slide, where we've seen quite a dramatic panic move within software. And the chart on the right-hand side is the US software ETF, the IGV. And that chart dates back over 20 years. And you can see that massive spike in volume in the month of February. Those kind of spikes in volume, when they move across a whole sector and are indiscriminate, tend to speak to a little bit of indiscriminate panic type behaviors. And another way of thinking about it is, if you look at those charts beneath, that's basically software against staples. So software in red on the chart on the bottom left, staples in green. And you've seen now software, again, these are 20-year charts, has seen the most rapid derating since, again, the year 2000. Same thing on the right, you can see now that in red, that staples is now more expensive as a sector than software. And obviously staples itself is not a terrific neighborhood with negative volumes and deflation rolling through. So again, before anyone makes dramatic moves, I suggest it's important to have a framework and think about the math. So one way that we're thinking about it, and I'll just leave you with a few thoughts in terms of risks and opportunities on the next slide, is diversification again. I started on this topic. I'm going to end on this topic. I think it's really important within the portfolio to have some of the portfolio directed towards what's working now, the CapEx cycle in AI. And so that's fish where the fish are right now. And so think about some of the stocks that, for example, we've owned in the portfolio, like a Teradyne, like a Disco, like a Hoya, like a Fujikura. Clear beneficiaries right now. But I think it's also important to think about what are the opportunities coming down the road in the next 6 or 12 months. And those are the things which are dislocated. And that's, skating to where the puck will be and looking at where the opportunities will be 6 or 12 months from now. And you need a framework to think about what business models will be durable in an AI agentic future. And in that regard, again, you need to create your own framework. We're happy to talk through it with you, but think about a few things we think will be durable in an agentic future. They're things like regulation, which will move not at the same speed as technology. Network effects and liquidity, where a business model provides that, even agentic future will look for that. Think about proprietary data, which makes a business model better than an agentic business model without those inputs, as well as just simple switching costs. So I would encourage you to think about having balance and having a framework, and then also consider the alternative view. What if software swallows AI? What if it's co-opetition, not cannibalization? Lots to say on this topic, but I'll leave it there right now, Toby, and invite questions.
Great. Thanks very much, Andrew. And we'll be coming back at the end of Michael Karagianis' session to talk about the impact on the approach to portfolio management that events like the weekends bring about. But it's now my pleasure to hand over to Michael Karagianis. Michael is the head of wealth for JANA, responsible for their sector engagement in wealth and also with family offices. And it's a pleasure to ask him now to speak about this topic of global equity investing and the way they see the market at this time. Michael, over to you.
No, thank you, Toby. And I guess the opportunity from our point of view is just to step back a little bit and look at some of the macro themes and structural backdrop that is driving markets generally, and then focus in on how to deal with that from a global equity perspective. So if you just step forward a couple of slides to look at the structural environment, we put out a paper at the beginning of this year that really looks at some of the key structural drivers. We update this every year. But over time, things are certainly evolving. And one of the things that is becoming increasingly apparent is that we're now in a multipolar world. And that is something that I guess is being driven by a fragmentation of this sort of globalization push that characterized much of the post-World War II environment. I won't go into in too much detail. I think it's sort of been written about enough. But one interesting chart shown there at the bottom, if you can see it, don't have to look too much at the detail, but basically, the level of trade that is now subject to trade restrictions between different countries, I think is very reflective of this increasing polarization that we're seeing, and not just amongst, historical antagonists, but even historical allies that this is occurring. So it is accelerating and certainly has been quite noticeable over the last year or so, significantly. The implication, or one of the implications of this, is that it makes supply side economics all that more important in terms of determining what the outlook is for economies and what the outlook is for inflation. We've lived in a historic environment where globalization basically reduced trade barriers, and manufacturing could migrate to lowest cost producers. That is now increasingly being upended, and the potential quid pro quo for that is that we look at an environment now that inflation is going to be structurally higher than average, and potentially with greater volatility through a cycle and greater variability between different countries and regions as well. So a lack of economic synchronization potentially, or reduced economic synchronization as a consequence. Economic nationalism and fiscal intervention, I think this is an overlapping theme. So clearly one thing that is a powerful factor that is driving this multipolar world is economic nationalism. Whereas, increasingly we're sort of being subjected to policies that are beggar thy neighbour policies, where historically it would have been, that economic cooperation and trade restriction or reductions in trade restriction resulted in a win-win. We're now in an environment of win-lose, or potentially even lose-lose. Clearest examples of this, the increasing tensions between China and the US, but of course we've seen the Middle East become increasingly a flashpoint, and obviously looking at the protagonists stepping back from that. Obviously there's large players that sit behind the scenes that have a vested interest, including China and Russia, in what's happening in the Middle East as well. Again, this is potentially inflationary. We're seeing fiscal policy being used increasingly by governments to remedy demand shortfalls. I think, basically the GFC and the post-COVID period legitimised massive expansions in budget deficits, and once politicians believe that the cat's out of the bag now and they can get away with it, I think the propensity to repeat it, and indeed not even make a pretext of controlling it, becomes a greater issue. So budget deficits in many countries are becoming very large, and one factor associated with that is the payment of historical debt. We worry about debt levels in Australia, but we look overseas and we see some truly significant government debt levels in Europe and the US, and indeed to some extent in Asia as well. That chart there just shows that one of the driving factors for this increase in fiscal expenditure is military expenditure, and it's not just the US doing this. You can see, very strong upswings in terms of what European expenditure is contributing to this, as well as what we're seeing in Asia and Oceania as well. So it is if there's a global theme, it is increasing belligerence and increasing willingness to widen defence budgets, and that really takes us back to an environment that we haven't seen since the end of the Cold War. We reaped that globalization dividend as a function of the collapse of the Berlin Wall. But maybe the wall is being rebuilt, but in different context now. Technology and innovation. Andrew's talked significantly about that, and wouldn't disagree about the benefits. Obviously, you can take a very glossy-eyed view of what the benefits will be, and you can be somewhat more sanguine. I think we're seeing a polarization of views out there, and obviously people are beginning to worry about the downstream effects of this investment, which obviously has affected the software sector more recently. As Andrew correctly pointed out, it's been very non-discretionary. I think the market hasn't shown a lot of discretion in terms of how it's positively viewed expenditure on AI technology, and hasn't taken a particularly discretionary view as to the negative effects and how it flows through to certain companies. I think our view is that it's going to be much more sectoral, and it's much more company specific, as we've seen through previous significant technological cycles. There'll be winners and losers, and it's probably an environment, in our view, that really is best dealt with through active management. Managers that actually understand the environment and understand what it's going to take to be a winner in this space, and what the potential pitfalls are for losers. The question is, of course, are all active managers well disposed to actually make those judgments at this point in time. It is a very difficult call at the moment. Suffice to say, it is a massive source of volatility and probably likely to remain a source of volatility moving forward. And the last two, I've lumped them together in the interest of just getting it on the page, but demographics and climate change, these are very medium, long term, but in our view, probably going to be somewhat offsetting. One could be inflationary, one could be somewhat deflationary, but in any event, they are certainly the backdrop that is going to drive and influence markets over the course of the next 20, 30, 40 years or thereabouts. Just bringing all that together in terms of implications on the next slide. Thanks, Toby. In terms of our view, what it suggests is an environment that probably requires a greater risk premium within assets. Inflation is likely to remain higher on average, at least for the near to middle term. Longer term, maybe some of those effects from demography, energy transition, and so on can actually be positive. But at this point in time, I think the essence for the next 10, 20 years is potentially on a higher backdrop of inflation, and that influences interest rates. It's likely that over the next 20 years, interest rates are going to be on average higher than what we've seen over the last 20 years. And that will not only have an impact on interest rate markets, but of course on the valuation of equity markets. Fashion dividend discount theory, for every earnings expectation, if your discount rate is higher, then the current valuation for equities should be lower. So to offset that, we are going to have to see greater earnings growth, and you are going to have to expect and reasonably predict a dividend coming through from this AI investment, so that there's some uplift in efficiency that flows into corporate profitability to offset a higher inflation and interest rate backdrop. And then economic growth, it's just going to be less synchronized. It's going to be less synchronized amongst sectors. It's going to be less synchronized amongst regions, and therefore, in our view, taking purely passive approaches to markets may not necessarily give you the benefits that you want in this sort of forward-looking environment. Bring that back to something that's more meaningfully able to be invested in, just looking at the next slide. At the present time, global growth has surprised on the upside, and that was certainly evident last year, and I think was a major factor that helped propel equity markets. The fact that growth surprised on the upside, but it also fed into a higher level of earnings than had been predicted globally, in particular at the beginning of last year. But we also saw it in Australia to some extent, particularly in the resource sector. We're seeing it not just in the US. The economic outlook has improved in Europe, the UK. Going back a year or so ago, might be easy to forget, but the UK was languishing in recession. It's now out of recession. It's not a vibrant growth story, but it's a heck of a lot better than it was. China remains a structural problem in terms of what's happening to the domestic economy, and in particular the real estate sector. But one thing we are seeing is that China seems to be doing a very good job in terms of exporting its way out of the worst case scenario. And there has been a surge in exports, which is interesting, given that the US has been purportedly tightening up on imports from China. China's clearly doing a very good job at redirecting those exports at this point. Inflation concerns linger. Going back 6 months ago, there was a rush to predict how far central banks would cut interest rates, having over-tightened. And now we see the market being a little bit more cautious, and of course, most recently, the Reserve Bank raising interest rates. We could see another interest rate increase in Australia. I suspect it won't go too far because the currency has certainly been appreciating as well, and that will act as a bit of a headwind. But in the US as well, I think there's a lot more caution now as to whether the Fed does have the scope to actually cut interest rates. As to whether they do, I think is partly the geopolitical realm, and we'll have to watch that very closely. So moving on to some of our market and asset class views. Growth assets we're still reasonably disposed towards, and global equities. You look at the multiples, and Andrew put up some multiples for large cap, and shows that it's quite a premium through history, and compared to other sectors such as small caps. It's been justified thus far because interest rates have remained relatively low, and we've seen corporate earnings surprising on the upside. I think the challenge this year is that we start the beginning of the year with an expectation that corporate earnings are going to be quite robust, and that's different to what was the case early last year, where there was a lot of concern about recession in the US particularly. So I think it all hangs on where earnings go over the course of the next year. We have to see markets continue to be impressed by the earnings story, and if companies or sectors or indeed markets disappoint on the downside, that I think is where the pain point is, and we could see more significant corrections. Obviously, there's been corrections as markets have, or investors have looked to impute the effects of AI. I think that's a lot of volatility at this point, and it's been non-discretionary, as Andrew says. That presents potentially more opportunities than risk at this stage. But I think we need to see earnings continuing to hang in there at this point to justify continued appreciation of the market. One thing we would point to is, hedged versus unhedged. Our view is probably to prefer hedging of global equities at this stage. And we've had that view for a while. The Aussie dollar's obviously gone from 60 cents at one stage last year to just over 70 cents. And interestingly, hasn't fallen much in response to the events of the Middle East. I think what we're seeing basically is potentially a long-term structural shift in the perception of the role of the US dollar in portfolios, and probably an understanding that the US administration actually wants the US dollar to be structurally weaker as effectively a trade lever to pull. And if that's the case, then I think you go with the flow and keep your hedging in place at this point. Australian equities, not as attractive in our view. I think the opportunity for earnings growth is more limited here, and certainly it's a more concentrated market, as Andrew pointed out. But the financials, it's just hard to see whether they're going to ring up double-digit earnings growth in this environment. Risk assets overall, that does place the emphasis on risk assets. We think that you've got to remain reasonably invested there, but a little underweight perhaps. So if you're a little underweight defensive assets and a little underweight growth assets, where do you put your money? And I think we'll come back to this point, but I think alternative investments in this environment where there's such a high level of uncertainty, you don't really know what's going to happen. The potential for alternative outcomes is great. Alternative assets that really try to avoid having too high a correlation with traditional assets, I think, is not a bad resting spot at this point. And we would encourage investors to remain reasonably exposed to that sector. If they don't have exposure, to consider it at this point in time. So I might leave it there. Thanks, Toby.
Great. Thanks. Thanks very much, Michael and Andrew. So let's come back to the matter of the moment, which is the impact of an event like this weekend. So I'm not going to ask each of you, well, what has this, what have you done? More to the point, Michael, we might start with you. How does an event like this, with the uncertainties that you touched on in your overview, feed into the way JANA approaches portfolio construction?
Yeah, look, and I would caution against saying, let's try and work out how to predict the next event that's going to occur. I don't think there's any real way of doing that. There was flagging that there would be military action, and of course we saw what happened with Venezuela. Probably was a couple of months ago or so now. So the precedents are being established, and that is, I think, part of this economic nationalism and so on. I think suffice to say that you would expect that more of these types of events are going to occur in this environment where the rule of international law is probably less of a consideration. Diplomacy is less of a consideration. and might is right is probably more of a focal point. If you've got increased spending on military, then woe behold the politician that doesn't actually use it. So I think you could expect that these types of events are more likely to occur. In terms of the impact, we've seen gold bounce. I think gold's now trading at a record high, exceeds what we had at the beginning of the year. In Aussie dollar terms, oil prices have bounced, although they've been conditioned somewhat because OPEC's come out and announced they'll top up supply a little to try and just stabilise the market. You've seen equities down a little in futures trading. You've seen the bond market rally a bit. So that's an interesting development because people have talked about the death of the 60-40 portfolio or, bonds as a defensive call. Well, in this type of environment, they do their job. Government bonds actually start to rally as a safe haven and provides a bit of an offset in portfolios. Credit, on the other hand, is not particularly defensive in this environment, and you tend to find that when we get these sorts of dislocations, and you see credit spreads potentially start to widen again. But what is likely to be the outcome? I mean, I think you could spend a lot of time focusing on what rockets are falling where and so on. The real make or break in terms of what's happening in the Middle East at the moment is there ultimately medium to longer term disruption to oil and energy supplies, oil and gas. And about 20 to 30% of global oil and gas supplies are funneled through the Straits of Hormuz, which of course Iran sits right on top of, and it's a very small gap in that strait that they can control and will potentially control. There's about 150 oil tankers apparently that have been told if they try to run the Straits of Hormuz at the moment, they'll be fired on. And I think one or two already have. So not surprisingly, a lot of them have dropped anchor waiting to see it out. Now that's okay in the short term. This could all blow over potentially, and in a week's time, it's back to normal. Oil prices stabilize. But, worst case, you could see a blockade of the Straits of Hormuz and oil prices shoot to, over $100 a barrel. So that's the great uncertainty of these sorts of geopolitical events. How do you deal with it in a portfolio? Well, not by predicting what's going to happen, because I'd challenge anyone to be able to do that, but by having the necessary portfolio construction in this environment such that, when something like this happens, there's always something in the portfolio that's going to react positively as opposed to just negatively. And if you've got, a portfolio that's comprised, for example, of equities and credit, well, they're pretty much going to react negatively to this sort of environment. If you've got a portfolio, however, that's made up of equities and a lot of diversity in the equity managers, you've got a portfolio that's made up of bonds and credit, and the bonds, are very high quality bonds. You might have alternative assets, you might have a bit of gold, you might have hedge funds, low correlated strategies. Then you've got a more of a chance of actually smoothing the performance of the portfolio through this environment and not getting as hurt by it. So it's not about predicting, but it's about preparing, in essence.
And Andrew, as a portfolio manager who's selecting individual companies, when an event like the Middle East occurs, how do you think about, how do you sort of run through the list of what you own and what you don't own, and assess the impact on those companies?
Look, Toby, I think Michael hit the nail on the head with his concluding comments, which is it's really about portfolio construction going into these events as much as it is about your reactions afterwards. So to my mind, this significantly just reinforces those benefits of diversification within the portfolio, right? You need to have established a robust portfolio, both in terms of geographic and sectoral exposures before an event like this, to have that robustness. But in terms of, for example, the actions we're taking as a team today, our meeting this morning, the follow-up risk meeting we'll have this afternoon, the conversations we're going to have through this evening. Number one is we look at risk first, and then we look at the opportunities. So in terms of risk, simplistically, you can look at beta, you can look at sector exposures, but I think our risk conversation obviously goes significantly deeper than that. We want to look at the correlations and the exposures by customer and end market. So that's both geography as well as industry. So think about Classic example would be travel or luxury when there's a disruption like this. You want to think about supply chain. So again, oil price, Michael mentioned, very significant, but also we can think of the electronics industry or the autos industry. Are there going to be any component shortages? Are there any key suppliers that will have their own supply chains disrupted for various reasons? And then we also think about what's the behavioral aspects within industries. So CapEx delays. A lot of industries are driven by CapEx decisions at a board level. Will a board delay their decisions? Will that fundamentally impact a company that we either own or don't own? So we look at risk quite comprehensively in that standpoint. That's the first port of call. The second port of call is obviously the opportunities. Okay, with that in mind, looking at what may be impacted and may not be impacted, let's have a view on what we think is a fair value or a reasonable opportunity. And again, the benefit, as Michael said, of being an active manager is we're more than willing to deploy capital into these opportunities, because just like the last attack on Iran, or just like that DeepSeek moment later on last year, we can see significant moves 6, 9, 12 months later that benefits people who are active in moments of uncertainty.
Now, just a point to the audience, those of you who are listening in, there's one question there on AI, which I'm going to come to in just a minute because it's a good one. But if you have other questions for Andrew or Michael, please put them through the Q&A. So one of the things, Andrew, about this particular event is that even Trump has said, "Oh well, it might be a couple of days, or it might not. It might be longer." And so, in that environment of uncertainty, where it isn't clear who's had the supply chain disruption, who's having to cope with $100, potentially $100 oil prices. How does your process sort of respond to this sort of lack of clarity?
Yeah, I mean, again, we're very fundamental bottom-up investors. So we select individual companies for our portfolios, and we have quite detailed modeling and assumptions on both the industries they operate in as well as their own operations. And so again, having been through a number of disruptions, be it from political or macro, or again, the COVID period in the past, we have certain experiences and certain views which are expressed within our explicit forecasts. And so if you think about supply chain, it's a question of, we have so many days of inventory for a company we own. Do we believe that's a reasonable assumption that an issue like this will be resolved within a 3 to 6 month time frame? Do we believe it'll cause more than 9% inflation on the inventory they have in check, etc.? And so we test that at a very bottom-up level, because ultimately our view is always what happens to the earnings of these companies. We believe share prices follow earnings over time. And so again, if we have a view that the earnings are either robust, defensible, or indeed even going up because of an opportunity created by this, they're stocks we want to lean into, stocks we want to own. And again, stocks where opportunities may present. And obviously, again, where we feel the earnings are at risk, those are the stocks that, again, we would, in this situation, as an active manager, reduce positions in.
And Michael, as an asset allocator and manager selector, what are your expectations of the approach that managers take, and how do you look to combine, to think about the combination of managers at this time?
Yeah, look, it's a really good question, Toby. I mean, one thing you want managers to do is be true to label. So you don't want manager migration, and this is something that we watch very carefully. So you'll point very simplistically a growth and a value manager to your portfolio deliberately to balance each other. And the last thing you want is the value manager to start becoming like the growth manager, or vice versa, because it reduces the diversification benefits you get. And I think one of the harder things in this environment is style, structure of the portfolio. We have, for example, a lot of managers in the quality space that were doing very well a year and a half ago have had a terrible year over the course of the last year. And so picking style shifts can be as fraught as trying to pick major market turning points. I think they can be very abrupt and very focused about seemingly innocuous information. I think the software sell-off is an example of that. But in terms of putting together a portfolio at the moment, I think it's a bit like asset allocation, diversification as broadly as possible, because you don't quite know what's going to happen. And I think that translates to building an Australian equity or global equity portfolio, looking for style contributions from managers that are offsetting and complementary, so that or almost irrespective of what style takes precedence over the next year, you've got one or two managers in the portfolio that are going to benefit in that environment, albeit that others are probably not going to benefit. The other thing that I think is probably a shift in the way we've built portfolios over the last couple of years. We've been doing it for a while in the institutional space, but it's become easier to translate into the domestic space. Into the wealth space. You've seen, this sharp rise of market dominance of the banks in Australia and the mega cap IT companies in the US particularly. And that has caused a lot of investors to think about capitulating on active management and to move passive. And one of the concerns we have with that, of course, is that you're buying in at a very mature story at a very high multiple, and you're basically disproportionately exposed to those sectors. So if the turn comes, you are very exposed in your portfolio. So what we've tended to focus on is actually, instead of having the conversation in terms of passive versus active, bring in something more complementary, which we refer to as enhanced passive or systematic strategies that can be used as a core of a portfolio that try and manage the tracking error. So you have your high conviction managers more as satellites in the portfolio. So if it goes against you for a period of time, it's not going to really blow the portfolio out of the water. The other thing about systematic strategies are often that they have flexibility in their style. They have style signals that they can actually shift and adapt to as part of their process. And that is one area that we do actually countenance, that sort of style rotation within a portfolio with a manager. So we've tended to use these systematic strategies as more of a core in a lot of portfolios. May have some passive in there as well, and still use the active managers, but have them more as a satellite investment. And overall, you end up with still a reasonable alpha potential in the portfolio. The tracking error is still reasonable, but you're not getting affected by massive out of sorts type performances.
Okay. Well, look, one of the things which we had anticipated spending a good deal of time talking about, both today and on Tuesday and Wednesday, is of course the impact of AI. Andrew touched on it, and I'd like to come back to that. So Andrew, we're going to hear a lot about AI in this series. So why don't you expand on the way you think about the intersecting threads of AI? It is breakneck. It's evolving enormously, very rapidly. There is massive investment, as you touched on, and threats to established business models. Those who read the Citrini report last week are either panicking or holding their heads under a pillow. So how do you assess the opportunities and landmines in that segment?
Yeah, you're right, Toby. It's a time of significant opportunity and risk, and I think the opportunity couldn't have been more clearly expressed than those couple of charts, but particularly one on the top right on slide 11 I put up, when you saw the volumes going through the IGV index, right? That software index. And that amount of indiscriminate selling, because undoubtedly that was used for hedging of other portfolios, was so massive that it just tells you that there is an incredible opportunity going on right now, as well as obviously some short-term pain, right? So that's, I think, the easiest way to encapsulate visually the situation we're in. It's quite stark. In terms of how we capture it and how we avoid the landmines, again, I think one is, and we touched on this in the latter slide 12, is diversification. We started on that topic. We continue with that topic. Is look, you need obviously stocks in the portfolio which are working now. Those are stocks levered into the capex being spent this year, right now, in the next 6 months and in the next 12 and 18 months. And so those are classic sort of the data center and related plays. So we mentioned a couple of names, whether it's Teradyne's up 220% in the last 8 months, or Disco up 100% the last year, Keysight, Hoya, Fujikura. There's a number of names that we own the portfolio. Others will own the portfolio, done tremendously well. I think the important thing when we're thinking about how to capitalize on where we are right now is also be forward looking. Don't just think about what the companies are printing now or in the next quarter, but think about the companies that will be printing numbers in 9, 12, 18 months from now. And those are the significant, like I say, opportunities that are probably dislocated in the short run. You need a clear view, therefore, of what those barriers and those durable moats are looking forward in a world where agents are acting on your behalf and on your enterprise's behalf. And those enterprise behaviors will therefore be less emotional and will happen at a faster speed. And so within that context, again, we think about what's a durable moat. Regulation, we mentioned, because industries and regulation don't move as fast as technology. We think about network effects, because an agent looking to transact something will still look for a pool of liquidity. You can look for proprietary data, which again makes a business model function better than an agent who simply does not have access to that data. You can literally outprice them, outperform them. And then there's just enterprise switching costs over time, where, again, an alternative solution may be cheaper, may be faster, but it's simply not worth the risk. It's not worth the incremental that it gains you. And I'll give you a recent example to kind of bring that to life. It's a stock that we hadn't owned, we'd long-term admired, and we just added it to the portfolio in the last couple of weeks as the stock sold off very, very fast. It's called Experian in the UK. It's one of only 3 global credit bureaus. So it effectively does the analytics on 800 million pieces of data it has on 400 million pieces, on 400 million human beings across 45 countries in the world for 150,000 enterprises. That individual data is subject to regulation. So there's one moat. There's a network effect because it's a single pool of liquidity for that information. It's proprietary data because you cannot simply collect it by scraping the web or synthesize that data. And again, the cost of switching out of that for a JP Morgan or a Commonwealth Bank or a NAB relative to the alternative is probably incrementally not worth it, and certainly not incrementally worth the risk. And so that's an example of a stock that might be short-term dislocated, for example.
One of the questions that came from the audience concerns energy requirements. You spoke about data centers, the Teradynes of this world. So how do you see, how do you think about reliable energy supply for the hyperscalers and the data centers?
Absolutely. So I think Jensen Huang said it quite clearly actually last week, is that ultimately compute will equal revenues in both the present day and those who adopt AI going forward. And compute is a function of energy, right? And so energy is ultimately the gating factor for revenue growth over time. And so as we look at individual companies' ambitions in terms of the compute they're putting on, we correlate that to obviously their energy supply and their background. So when we sat down with Amazon in November last year, our number one question about that was their certainty of energy supply for the build out of their 15 or 17 gigawatts over the next few years, because that's a clear gating factor that we understand. And it also, weirdly enough, gives us a lot of confidence in terms of how far and how fast this story can play out. Because again, the assumption that there can be such massive change over a particular short period of time, like 6 or 12 months, is simply not realistic from an energy standpoint. It's very realistic over a 5 or 7 year horizon, but not over a 6 or 12-month horizon.
So just to sort of expand a little on the insights that thinking about AI gives you, and you mentioned your own use of AI, the fact that you're spending the $60 a month. Does it also give you insights into companies who are, unlike Experian, that you just mentioned, companies that are unlikely to have a defensible moat? And so are they just companies that you avoid, or do you have a way of actively betting against them?
Yeah, so again, we've done quite extensive work on this last year. And of course, we did, at the beginning of our work, identify 1 or 2 companies where we thought the risk was higher than we were comfortable with, or the risk was simply not yet priced into the valuations. And so we exited a number of companies in the portfolio for exactly those reasons. So that's obviously one thing we do, is make sure that we're not exposed to companies we feel are at risk. Obviously, another thing to think about, obviously, is within some of these concentrated benchmarks, the large cap global benchmarks, it's very important, obviously, to not have exposure to benchmark stocks where you feel the business model is potentially at risk or not evolving at appropriate pace. So that's how we manage the downside risk.
Right. Well, look, Michael, Andrew, thank you very much for what's been a really interesting initiation into our series on global equities at a time of considerable uncertainty. Let me just share with you again our 2 upcoming presenters. So tomorrow we'll be hearing from Russell Investments and Chad Heitzman of GlobalX. And on Wednesday, Andrew Stewart from Mercer, Tom King from Nook. The themes that we've spoken about today around AI and around dealing with uncertainty will come out in both of those 2 sessions. And the presenters from Tuesday and Wednesday will have had the advantage that Andrew and Michael didn't have of a little more preparation time, an opportunity to collect their global thoughts. So thank you very much for joining us today. Andrew, Michael, thank you very much for your presentations. And we look forward to having each of you join us again tomorrow and on Wednesday, where we'll look at global equities, the role in the portfolio, the opportunities and risks that they give rise to for investors. Andrew, Michael, thank you very much for your time.
Thank you.